Good day, folks. Hello and welcome back to the Sterlinx Global channel. I'm Jay, an account specialist at Sterlinx Global, a UK-based accounting firm specializing in e-commerce and local businesses. As always, thank you so much for tuning in today. And if you're new here, glad you could join us on this lovely day. On this channel, we do a deep dive into different pain points and challenges that our clients usually have, and we discuss valuable insights that can help entrepreneurs, self-starters, and freelancers. Right now, we're doing a series related to accounting and accountants. This means that we have a lot of content tackling a range of topics related to business accounting. And for today, we'll be discussing financial ratios, also known as accounting statistics. As an entrepreneur, it's crucial to know your business's financial health at a glance, but for many owners, looking at numbers on their financial statements can be a little daunting. One way to ease the confusion is to look at financial ratios. A financial or accounting ratio measures the relationship between two or more components of a company's financial statements. It is a tool that turns raw figures into meaningful information to help business owners gauge performance and manage operations more efficiently. There are numerous financial ratios to track, but here are 10 of the most important metrics that dropshipping accountants from Sterlinx Global will tell you to keep your eye on. First on the list, current ratio. Sometimes known as the working capital ratio, this financial metric measures your business capacity to pay its short-term obligations, which are payables and debts due within 1 year, using current assets. Current ratio is equal to current assets over current liabilities. A ratio of 1.0 or greater is ideal, indicating you can settle every pound or dollar owed for accounts payables, accrued expenses, and maturing debts with your existing short-term assets like cash, accounts receivables, and inventory. Second metric that matters, quick ratio. Similar to the current ratio, it also gauges liquidity or the ability to pay off existing debts. However, they differ on the assets considered for repayment. The quick ratio only covers highly liquid assets such as cash, marketable securities, and accounts receivable. Dropshipping accountants calculate it as follows. Quick ratio is equal to cash plus marketable securities plus accounts receivable over current liabilities. Also known as the acid test ratio, it excludes inventory and prepaid expenses. The former takes time to be converted to cash, while the latter can't be used for a payment. For most companies, the ideal metric is above 1.0. Third, accounts receivable turnover. This activity ratio examines how well your business is at managing its receivables. A higher figure means you are efficient in collecting receivables and that many of your customers quickly settle their debts. Also, a high accounts receivable turnover indicates that your company doesn't extend credit or runs mainly on a cash basis. Accounts receivable turnover is equal to net credit sales over average accounts receivable. A low metric isn't good as it suggests a poor collection process, bad credit policies, or financially unsound customers. It can also mean distribution troubles since products aren't delivered promptly and customers delay settling their receivables, which is common with drop shippers. Still related to our third is the next metric, day sales outstanding. Another activity or efficiency ratio, day sales outstanding, or DSO, estimates how long it takes to get paid after making a sale. While similar to accounts receivable turnover, this metric refers to the number of days before your business can convert its outstanding receivables to cash for a given year. DSO is equal to accounts receivable over total credit sales times 365. A high DSO number shows a long waiting period to collect outstanding accounts, which can strain your cash flow as funds remain tied up in receivables. Dropshipping accountants prefer a lower figure, which means fewer days to get the money. Number 5, asset turnover ratio. Asset turnover is an important performance metric that measures how efficiently a business utilizes its resources to generate sales revenue. Accountants calculate it. Asset turnover ratio is equal to net sales over average total assets. The higher the ratio, the more efficient your business uses its assets to generate revenue. Since it is a multiple, a figure of 2.0 means that for every £1 of assets owned, your e-commerce business makes £2 in sales. Note that it's more meaningful to compare your metric to competitors in the same industry. Number 6 on the list, debt to equity ratio. This financial metric shows a business leverage position. Being highly leveraged means you have a significant amount of debt compared to industry standards and vis-a-vis your capital. Dropshipping accountants estimate it as debt to equity is equal to total liabilities over total capital. A ratio of below 1 indicates that your business relies less on debt and more on capital to fund its operations. The reverse applies, which means a higher number suggests the company is more indebted. While borrowing is usual for merchants, too much dependence on debt can lead to defaults in downturns. Now, let's move on to profitability ratios, which I know that most of you are interested in. The 7th most important accounting statistic is gross profit margin. A critical financial metric for merchants like dropshippers, this profitability ratio shows the markup earned on products. It is calculated as gross profit margin is equal to sales minus cost of goods sold over sales. A higher ratio is preferable since it means items can be sold at higher prices than their cost for more gross profit, leaving you with enough earnings to cover operating expenses. If you have various products sold, it's ideal to compute for each item's margin to determine whether you need to adjust pricing. Next up, operating profit margin. Another key measure of profitability is the operating profit margin. Dropshipping accountants compute it as operating profit margin is equal to operating income over sales. Operating income takes sales revenue and deducts the cost of goods sold and operating expenditures, including utilities, marketing, and administrative expenses. The operating margin shows your business operational efficiency in making a sale. A high margin is preferred and achievable by reining in overhead costs. Number 9 is still related to profitability, and that is net profit margin. The net profit margin is among the fundamental metrics that business owners should always be aware of. This ratio measures how well a company manages its overall costs to turn a profit from its revenues. Remember this formula: net profit margin is equal to net profit over sales. You can interpret it to gauge your business performance and efficiency in converting sales to earnings while accounting for all incurred costs in running operations. As an example, a 0.10 or 10% margin means you keep 10 cents as profit for every £1 sold. For online sellers, a higher number is preferred. The higher your margin, the better you are at pricing products and controlling costs. Lastly, return on assets. An important profitability measure, the return on assets or ROA, gauges how effectively a business uses its resources to generate sales. While this ratio is critical for retailers to see the relationship between inventory and sales, dropshippers will also benefit from looking at it. Return on assets is equal to net income over total assets. For dropshipping accountants, it shows the profits you can get out of every £1 of your assets. It's better to look at how ROA changes over time. An increasing metric is preferable since it points to efficient use of resources or means you've made good investments during the period. Before diving into FAQs, let's do a quick rundown of the key accounting statistics that entrepreneurs like you should track to help you make better business decisions. To measure liquidity, or your ability to meet immediate creditor demands, you have the current ratio and quick ratio. And if you have sales on credit, you should be keeping a close eye on your accounts receivable turnover and day sale outstanding. If you have liabilities like accounts payable from your suppliers or bank loans, you want to know if you've been borrowing more than you can handle. An excellent gauge is your debt to equity ratio. If you want to know whether you're profitable or not, examine your gross profit margin, operating profit margin, and net profit margin. Lastly, asset turnover and return on assets may look the same, but they aren't. The former measures your efficiency in using assets to generate revenue, while the latter focuses on how much profits you earn from your resources. Let's answer a couple of frequently asked questions about accounting statistics. Why are financial ratios important? While the balance sheet, income statement, and cash flow statement are useful, they only offer limited insight into your business. Financial ratios are much more helpful in gauging performance since they come from at least two different components to reveal operational efficiencies and inefficiencies. How can accounting statistics improve my dropshipping business? Since they measure the relationship between various figures in your financial statements, you can quickly evaluate your business's financial health and uncover warning signs. Before things become even more problematic, you can take steps to stop and improve the situation. Can I compute these ratios myself? Yes, you can. As an entrepreneur, it's a fundamental skill to compute financial metrics and understand what they mean. There are many available resources you can use, but if you want to get more accurate figures, it's best that you work with an accountant from Sterlinx Global. In summary, the above key financial metrics are only some of the essential tools that entrepreneurs can use to evaluate their business performance and profitability at a glance. While there are many others, it's critical that you focus on these ratios regularly to identify risks before they worsen and implement changes for a better bottom line. Moreover, ensure you get accurate figures from experienced dropshipping accountants, such as those from Sterlinx Global. Everyone, that's all for today. We hope that you've learned a lot about financial ratios from today's discussion. I know I did. To see how you can help more, do check out our site, sterlinxglobal.com. We have tons of accounting-related articles that could help you stay in the know. So if you enjoyed our tips and tricks or want to learn something more similar, please like, follow, and subscribe to our media channels. Again, my name is Jay of Sterlinx Global, and I hope to catch you on the next one.